minutes and
and
3
then we'll
minutes
probably
and 2 minutes.
we'll cut it short and
This is-
make up the difference.
This is doing the fillers for the show down in Florida.
Okay,
So it has to-
Yes, you guys have been emailing him the show the whole year.
Oh no, because it's hard once he
Once
goes
you put
back,
Yeah.
to take it
come out.
off.
So I figured
Okay.
If he's coming, we'll just leave it there.
So
Okay.
if we could send him these fillers, that would be great.
Then he edits them right in.
'Cause it's hard, especially with like Tyler. If you start saying, okay, stop doing it, start doing
Right,
it, all of a sudden,
right.
then it's gonna get messed up. So we left it alone.
So we'll just do part of it today and then part of it next week.
That's fine.
Okay. Do you know what you're doing? You got it on?
Just say a few words and we just check your voice level first.
Testing, 1, 2, 3, 4.
Happy New Year. Welcome to 2016.
Okay, I'll have to go whenever you are.
Okay. Ready? Well, hello, people in Florida. We're back. EG Tax. Our radio show once again is on the air. For those who have heard us last year, welcome back. For
Yeah.
brand new listeners, we are EG Tax. We do have an office down on Airport Pulling Road,
Right.
1450 Airport Pulling Road.
That's right. Right across from Tamiami Ford.
Yes,
Yep.
right next to 7-Eleven and Fabio Pizza.
We've
So-
been there a few times, right?
Yes,
How
yes.
was the pizza there?
Very good, very good. If you want to reach us there, our phone number is 239-262-2009. I guess you don't have to hear us say 239. But we're from Buffalo, New York. We're out of Buffalo. We do have an office. So when you guys are enjoying the sunshine, we're freezing right now.
Yeah, 14 degrees.
Yes. So again, EG Tax, we're back. We want to help you with your questions. If you have questions during tax time, you can call us at our office or on our radio at 1-800-616-WBEN during Saturdays from 3 o'clock to 4 o'clock. And then the following Saturday, you will hear your question on the air.
Yep.
So again, 1-800-616-WBEN. For your questions, go to our website at egtax.com. You could even click there, Ask the Tax Lady. And Esther will respond right to you, probably within 30 minutes, knowing her. But you will get your questions answered there. We want to help you with whatever tax needs you have. Again, we're located at 1450 Airport Pulling Road, right across the street from Tamiami Ford. The phone number is 239-262-2009, and we look forward to you joining our family. Okay, you want to start off with a commercial or commercial
Question. Ready?
Yep.
Okay, so I've got a question here, and this is from Samantha. And Samantha asks, I just sold my mother's house. She put it in a life estate 10 years ago, and she passed away. Sorry to hear that. When she passed away, the house was worth $109,000. I sold it for $117,500. Do I have to pay tax on the $8,500 gain? And so I can start this off, and then you can chime in. The thing is, if you inherit a house, you get a stepped-up basis. However, if it was a life estate, that means it was treated as a gift, and it goes back to the original basis, right, Chris?
Right. You have to check your paperwork out, the paperwork on the house, to make sure if your names were put on the house, on the title, when the mom put it in the life estate. Because if it was, then you have to go back to mom's original basis, add up all the improvements, and figure out what the gain is. Because so say that is $60,000, you sold it for $117,500, then you have a $57,500 gain, which you would have to pay tax on.
Right.
But if your name wasn't put on the title until mom passed away, then you're right, where you would have to pay the tax on $7,500. Now, if you lived in that house for 2 out of the last 5 years, you could avoid, if that was your primary residence, avoid paying tax on that whole gain So there is a loophole there. So
Make sure you find out all the details. You got to go back to that original life estate. You have to find out that, and then if you find out that she did put your house in, you got to find out. You got to do homework. You got to find out what mom originally paid for it, and then you got to ask the questions. Have you lived in it? Because then there's another little caveat that changes the whole picture. So you really got to do some homework.
do your homework. Yep.
Yep.
And for people who may be in similar situations to Samantha, I believe you said, right? When your parents are alive, talk to your parents. And when they say we're doing this, don't just brush it off. It's very important. Find out what assets they have. Where we've seen so many people not know what mom and dad have when it comes to their financial situations when the time comes and they pass. So start talking to mom and dad. I know it's a hard topic to do, but have that conversation, and believe it or not, it will make an easier transition.
I just helped a client the other day, and her mom passed away, and she found that her mom had all these IRAs, and her mom wasn't taking required minimum distributions out of the IRA. So now the daughter is left with doing all these amended returns.
And you're talking major penalties potentially.
You got to make sure you do those hard questions.
Yes. Okay, so we'll go back to our show. This is so much fun.
I'll chime in with another question.
Sure.
Okay, so Chris, we've got Margaret who writes to EG Tax. She says, my oldest just started college this year. After scholarship and grants, we are left with little over $5,000 in tuition out of pocket. Is there anything on our tax return that we can write off? They're going to be happy.
You want give them the good news?
Sure. Now, if this is your their first stint at college, the first 4 years, there's something called the American Opportunity Tax Credit, and it's a wonderful, wonderful credit. The first 2,000 is 100%. The next 2,000 is 25%, and so it's a $1,500 non-refundable and $1,000 refundable credit. It's a great credit, and so potentially you're going to see $2,500 because of
for the
this.
next 4 years.
For the next 4 years. 4,000 is the maximum, so you coming in at 5,000 is perfect. And don't forget, if you are in a state that also has a college credit, don't forget to look at the college opportunities on the state return as well.
And Margaret, don't let your smart son, if it is your son, your oldest child, claim themselves on the tax return, because that's what their friends do.
Right.
Because he's not entitled to the $1,000 refundable credit, so he may save an extra $80 to $300 on the tax return, but you're losing $2,500.
Right.
So keep the money yourself and give him $300, and then it's a win-win situation for both of you.
The law says that you can, as long as you support your kids, you can claim the kids up until the age of 24, as long as they're full-time students for at least half of the year. And so make sure that you seize that opportunity, because like Chris said, the refundable portion would not belong to him.
Right. So give us a call at our office on Airport Pulling Road, 239-262-2009.
Ready? Okay, so I have Rebecca here, and she writes, Esther, on my 2014 return, I ended up owing $1,675 due to paying back the stimulus that I received during the year. I was told not to pay it. Am I right? And so I think she's right. Right, Chris?
Well, yes and no.
Okay.
This all goes to the lovely Obamacare. Okay, where she claimed her income when she filed for the exchange. She projected her income, I'm just going to put figures here, as $30,000. So she got a nice stimulus where the government helped pay for her health insurance. Well, when she did her tax return, oops, I forgot to claim my husband's income when I did the insurance. So now her income is $60,000. So now all that money the government helped pay for their health insurance that they shouldn't have been, they want back. So that's why you owe the money, Rebecca. But technically, you do owe the money. The government cannot do any collection actions against you. They can't hit you with penalties. They can't levy your bank accounts, your pay for it. So that debt will just stay out there. So if you have a refund the following year, they can take that,
I
though.
thought for 2014. Nope. Okay. Yep.
No,
and another important thing is she wants to make corrections going forward so that this
Yeah.
doesn't happen again. So make sure you go to the.
When you have a life-changing event and you have health insurance through the marketplace, call the marketplace.
Right.
Go online.
Make
That
changes.
change so you don't end up like Rebecca in the future.
Right.
Hate to sound like that. Use Rebecca as an example what not to do. But that's
Well, it's all a new world. This
is.
this health insurance and it tied to your tax return is a brand new
and it's
situation.
and not having health insurance is a 2% penalty this year
Right.
of your taxable income or 200.
95 a person up to 3 people maximum.
So you're looking 369 $885 maximum penalty.
Gosh.
So and it's only going to get worse next year.
Right.
So look to see what health insurance is available because it may start being cheaper to get health insurance than not having health insurance and pay the penalty.
That's right.
So this is EG Tax. We're here to help you with whatever question you have. You can call us to be on the radio at 1-800-616-9236 on Saturdays from 3 to 4. I know a little different timing than the show what you're listening to, but 1-800-616-9236. We'll take your calls. Next week, you'll hear your question on the air. Go to our website at egtax.com. Ask the tax lady. Call our office at 239-262-2009. A lot of different options to get your questions asked. We want to help so you can join our family. Thank you. Okay. Ready?
Okay, so Grace writes, she said, EG Tax Team, I'm thinking of retiring when I'm 62. My friends say I should wait until I'm 65 to start collecting Social Security and live off my savings so I can collect more Social Security when I turn 65. What do you think? So, if Esther was here, she usually says, my office is next to her, she usually says, take the money now. I mean, there's a lot of factors. What is your quality of life going to be when you're 85,
Yep, because what Tiffany's getting at is you're missing Social Security for 4 years. So take that monthly check, times it by 12, times it by 4. You're looking, it could possibly be $80,000 you're waiting to get so you get more Social Security when you're 66. So
outlive it.
So are you going to outlive it? And what that means is, so you get $250 more a month. Divide the $250 by the $80,000. You're looking about 15, 16 years to break even before you can have a party to say, I just beat the federal government.
Yeah, and I hate her to drain her savings. I
Yep.
mean, it's always good having that savings there in case you need it, It's just...
So we are one of the few people that will say, take your money now.
Yeah, because if you think about it judiciously, you really got to put pen to paper.
Yep. And if you don't need it, you can invest it. I know stock market, some people don't like the stock market. Interest rates, what interest rates?
Mm-hmm.
But it's better, a bird in the hand is better than two in the bush, right?
That's
the
right.
old saying.
Yep.
So Grace, we would say take your money and run.
Most likely.
Okay.
Yep.
And we're from EG Tax. We want to help you. Give us a call at our office located at 1450 Airport Pulling Road. Phone number there is 239-262-2009. We are right across the street from Tamiami Ford. So stop in and we'd love to see you.
Okay, so I got Maria. Maria from Naples, Florida writes, can I write off my iPad that I bought last year? I use it mainly for my job, but I also use it for for personal entertainment. Well, it sort of boils down to ordinary and necessary. Is this iPad ordinary and necessary for your job? And so sounds like it is. And so you want to prorate it. The percentage that is used for business, say it's 80%, 20% personal, she could take the 80% off on the Schedule A on a 2106. And so I don't know if you want to chime in, but it sounds like a green light to me.
Right. Yep. You could take the 179 right off. So if it costs you $600, as Tiff said, 80%, 600 times 8 is $480 you would have as a write-off. But then also if you have internet on it, and you're paying for internet, that monthly fee, 80% of that monthly fee would also be a write-off.
Right.
So definitely, and maybe you bought a case for it. That would be, and we all know how lovely those cords are with the iPhones and iPads where they keep breaking. If you have to keep buying a charger for it.
Save your receipts.
Yep. It adds up.
Yep.
And then what else could you be writing off with your job? Or if you're in outside sales, don't forget your mileage, your gifts to clients.
Cell phone use. Do they give you an office to work out of? If
or are
not,
you out of your house?
Right. There's this, the sky is the limit. If you have to travel for work, do you have to get a hotel? Do you have to rent a car? Do you have to pay tolls? Things like that. I mean, we all know the old adage, you can't take the miles from home to your first stop, but once you're at your first stop for the day and then you go to a second stop, those miles might be allowable. So make sure you keep a mile log,
That's right. If you have questions, give us a call, 1-800-616-9236. Again, this is on Saturdays from 3 to 4. You can call that number, 1-800-616-9236. We'll play you live in Buffalo because we are in Buffalo. We're playing the show down in Naples for you guys.
Yep.
So
Been in business for about 25 years.
Yep. We want to help you. We want you to join our family. We love helping you. If you're a snowbird, maybe you heard of us. If you're from Buffalo, because I know there's a lot of Buffalonians who go down to the Naples area, Fort Myers area. Stop in, get your taxes done there on Airport Pulling Road, 1450 Airport Pulling Road. Phone number there, 239-262-2009. Look at our website, egtax.com. You'll learn all about us. You'll get tax tips. Like us on Facebook and Twitter. If you do, you could be in a drawing for a free tax return. And that, save some money. That's a win-win, because we want to help you and you get a free tax return. So give us a call and we'll take more questions right after this. Stop, reset. Okay.
Okay, so I got Michael from South Buffalo. He writes, I just received a letter from the IRS saying that I did not claim all of my income. Something about sale of stock, but I never sold any stock. How can this bill be correct? Well, unfortunately, it probably is. I've seen this happen many times. For instance, Chris, I had a client 2 years ago, and his mother passed away. And so the broker had stock, and in order to switch it over into the son's name, it all had to be liquidated. And so the son wasn't aware that a stock sale had transpired, but it did. And it
that would have been a letter for mom, though, probably.
Right.
Or was, it all depends. But whose ever name the stock was in. But this probably is the broker sold. They reposition people all the time trying to make that extra money. You may not have called your broker and said, hey, Bob, sell this stock. I need some $20,000. This is him buying and selling to make you the money. Mm-hmm. So, again, you may physically not have received the money, Mike, but your broker sold it to try to make you more money to invest. So that is a sale that has to get reported.
Yeah, but now another thing is that the IRS is going to write you the letter like it has a zero basis. That means if you sold 20,000 or he sold 20,000, repositioned it, the IRS is going to send you a letter looking and assuming that the stock had a zero basis, which it probably didn't. It probably had a basis. It could have been a loss or a gain, but you have to find out what the basis is of that stock. And probably it's not going to be the situation that's on that letter. Would you agree?
Oh, wholeheartedly.
Yeah.
If you file a state return, it's going to impact the state return also. So make sure you have it looked at. Have a professional take a look. Don't just pay the bill.
Yeah, I've seen this many a times where there's stock sales and actually it was a loss. And so you'll actually walk away with a refund once we do the amended returns, Yeah.
Yep. So if you fall into this situation or any others you hear on our radio show, give us a call at our airport polling office, 239-262-2009. That's 239-262-2009. We are located right across from Tamiami Ford, next to Fabio Pizza and 7-Eleven, in between them. So we look forward to helping you, and come join our family.
Ready? Okay, I have Frank, who's writes in, I just evicted my tenant, and I realized that I not only need to paint every room in the house, but that I also have to replace 3 rooms worth of carpeting and redo a bathroom. It will take me about 3 months to complete. Can I claim the loss on my Schedule E when I file? Do I get to write off all of these repairs? And so the truth is, if you're repairing items, generally it's something you can expense on your Schedule E that year. Now, if it's something that, although he's putting carpeting, he's got to do new carpeting. So that's something, it's a depreciable event, but it is something that he can claim on his Schedule E, and anything that is, it's brand new, like a carpeting, he's going to have to write off over 27 and a half years.
Carpeting is 5 years.
You're right.
Carpeting is 5 years.
Now, what about the fact that it's going to take him 3 months to get it ready?
Right. Well, the good news is the painting is a direct expense. The carpeting is a capital improvement, so you got to depreciate it. The 3 months it takes to get rented, unfortunately, that lost rent, you can't write on the tax return lost rent, $600 a month, $1,800 as a loss. You only claim the rent you receive. So in essence, you do get to claim the lost rent because you're not claiming a full year rent.
Right.
So you will see a big difference on your tax return because of that,
And the bathroom redo, he's probably going, that will be 27 and a half
That will
years.
be 27 and a half
That'll be
years.
20, unless there's any like painting or, repair, then you could expense it the same year. But I think you're going to be okay. It's sad to hear that happened. It's cost of doing business.
That's the cost of rental property. Okay. And give us a call, 239-262-2009 during the week for our office located at 1450 Airport Pulling Road.
Okay, so I got Ray, and Ray writes, Dear Esther, I don't know why I owed so much money this year. Usually I only owe around $100. The only difference is that this year I had gambling winnings of $12,000, but I also had the losses to offset the winnings. So why would I owe $3,500? There's a chance that he collects Social Security, right?
I would say yes, he is a senior probably.
Yep. And why do you say?
Well, because if your net, let's see, gambling winnings at 12, but I had losses to offset it, so your net is 0. But unfortunately, the winnings go on page 1 of the 1040. Your gambling losses are an itemized deduction.
Not in the same place.
Not in the same place. So your income, again, line 21 of the 1040, that impacts the taxability of your Social Security. So it could be that 12,000 made your Social Security become 85% taxable.
Whereas in years prior, you didn't have that much tax because not much of your Social Security was taxable based on your income.
Right. And then the losses go on your Schedule A. So maybe you weren't an itemizer. Remember, the government gives you a standard deduction. If you're single person, standard deduction is about $6,500 for being over 65. So you get that. So now if all you're doing is claiming the gambling losses only benefited you by $5,000 more.
Mm-hmm.
So that impacted the tax too.
Right. That's
So
right.
you got to be careful. Gambling, yeah, it's fun, but it could nip you in the butt.
So
at
in
the
other
end.
words, that gain and the loss on his gamblings don't really wash each other out,
Right.
as people might think.
Right.
Mm-hmm.
Okay, so let's go back to our live show. Ready?
Okay, I have Jimmy who writes in and he says, EG tax team, can I use my HSA or health savings account to pay for my son's orthodontist work? Is an HSA a good idea? And so I can answer the first part. You can use your HSA to pay for your son's orthodontist. And Chris, do you think a HSA is a good idea? I guess it depends.
I would say, well, first of all, you have to have the only way you can have an HSA is if you have a high deductible insurance plan. So hopefully you do have that, because if you're contributing to an HSA, otherwise you're going to get penalized for doing that. But definitely an HSA is a good thing, because if you're on salary for $50,000 and you put $5,000 into your HSA a year, that means you're going to pay income tax on only $45,000. You're only going to pay Social Security tax on $45,000. So you're saving the 7.65% for Social Security if you're in the 15% bracket. So right there, the federal alone, you're saving 22% of that $5,000. That means $1,000 you're saving in taxes.
Pretty cool.
Yeah.
Pretty cool.
So definitely it's a good
And
thing.
HSAs, correct me if I'm wrong, if you don't use it for that year, it doesn't roll over?
No, it does. An HSA rolls over.
Okay.
It's a savings account.
Okay.
So it rolls over year after year. So whatever
Another
you
nice
don't
feature.
use, and actually, when you turn 70 and a half, it becomes sort of like an IRA. You don't have to use it for medical
That's cool.
anymore.
And probably the more members in your household, the more chances, the preponderance that you
Of
were
you're using it all,
Yeah.
because unfortunately health costs are going up
Right.
and going up
And
and,
you can use
going
it
up.
for dental too.
Yep. Anything except for over the counter you can use your HSA for. So hopefully that helped answer your question, Jimmy.
Okay, got it, Chris. Okay, I have Roberta, and Roberta writes in, and she says, so guys, I want to pay off my credit card debt about $25,000 before I reach 50 years old. If I take out the money out of my 401k, how much extra will it cost me when I file my taxes? My wife and I make around $85,000. So, boy, I always envision Esther jumping on the table right here and saying, no, 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 don't do it. Because if you are under the age of 59 and a half when you take money out of your 401k or your pension, not only do you pay the tax on it, but you pay a 10% penalty. And so effectively that money is going to cost a lot of money.
That on that 25,000, you're looking about $5,000.
Wow. And that includes what they're going to pay to some state.
Yeah, that's not including any states.
Right,
That's
right.
just federal.
Right, right.
So if your credit card debt is 25,000, you're going to need to take out about 32,000, 33,000 to break out even.
right,
So look into taking a loan from your pension plan.
right.
You know, if you own a home, look at a home equity loan. You know, there's different ways around it. Look at maybe even getting a 0% credit card.
That's right.
Pay off that high interest credit card with the 0%, because that's a lot of money you're saving, because then you're not paying interest on every payment. You're going to start eating that.
Yeah.
Maybe go to mom and dad.
Yeah. And then also, when you make 25,000, that's going to add to their income, and that's going to put them at $110,000 for the year. And so that could potentially boost them up into another tax bracket. So some of their income is going to be taxed at a higher rate. And so just
And
all
some
around
some credits could be
wiped out and gone. And so you really want to be judicious and make sure that you vent every other option before you take that angle,
So hopefully, Roberta, we helped you, and we did this. You talked to us before you took the money out, because unfortunately, a lot of people do it after they take the money out, and there's nothing you can do about that going forward. So you got to call us first with anything you want to do. You can reach us at 239-262-2009. That's our office on Airport Pulling Road, right across from Tamiami Ford. You can go to our website at egtax.com. Ask the Tax Lady is a link, and it will shoot an email right to Esther, who is the president of EG Tax, and trust me, she knows everything about taxes. Well, mostly everything, but what she doesn't know, she knows how to look it up. And we want to help you to keep the money in your pocket that you work so hard for. So again, give us a call, 239-262-2009, and we look forward to you joining our family.
Okay. All right. I have Chris from the island of Capri. He says, okay, I don't use a broker to help with my investments. I buy my financial magazines and I go to many seminars. Is there anywhere to write off these items on my tax return? Well, we talked earlier about somebody who had business expenses, and so this would also go on the Schedule A at the bottom, subject to 2%. I remember Esther taught me a long time ago, how certain things stick in your crawl. She said if there's anything generally that you use to make money, taxable money, you could write it off. And so the truth is, this guy is trying to make money, taxable money. And so he could write these items off most likely on the Schedule A, tucked away at the bottom of the Schedule A, job expenses and other investment miscellaneous expenses subject to 2%, right, Chris?
Right. And so if he's going to seminars, not just the cost of the seminars, but the books he buys for the seminars, the mileage to get to the seminars, maybe the seminars are in, let's see, you said he was in the island of Capri, maybe they're in Vegas. Mm-hmm. And he goes to Vegas for a financial seminar, or New York City. So his airfare, his hotel stay, that's all part of that investment cost.
Right.
So there is a lot there that you can use.
And he could also write off tax preparation
Tax prep,
costs.
yep. Maybe online software that he uses for his investments.
You could do safe deposit box around that same area as job expenses and things like that. So, and then, if you're a married fella, don't forget about your wife's expenses for work or job hunting. Maybe when you go to Nevada, you're also looking for a job. So you want to take those things into consideration.
Right. Good job, Tiff.
Okay, I'm ready. Okay, so I have Annie who writes in. Annie says, EG Tax, I'm thinking of starting a new business, collision shop. Maybe she's starting it with, some people are saying DBA, some are saying LLC, and some are saying corporation. What is your opinion on this? Anything else that you could recommend? Well, it's so funny, Annie. One of the things is when you're doing a collision shop or any type of business, when you hang up that shingle, is you want to have protection. And so when you're doing a collision shop, somebody could come in and slip on oil, or they could bang their head, or
Someone could forget to put
Right.
the nut back on when you're doing oil change.
Right. So right from the get-go, I'm thinking that you should have some type of corporation to protect yourself, and so that's what a corporation does.
Right.
In
But
initially.
for taxations, a corporation is its own identity. So that would file its own tax return. We would say do an S corporation, because that income then would flow. You do the tax return if there's a net profit or a net loss. That flows to your personal return, but you have the protection that Tiffany was talking about to do for that. So you only pay ordinary income tax on the profit. The loss is a subtraction from your other income. A C corp files its own tax return too, but if there's a net profit, the corporation pays its tax. So say you made
Double
a
taxation.
$30,000 profit from your business, and so the corporation is going to pay tax on that $30,000, and you go, but I want that money. That's my money. So you write yourself a check for $25,000. Well, now you just wrote a dividend check to you for $25,000. So the corporation is paying tax on $30,000. You're paying tax on $25,000 of that same money. So that's a double taxation. So really, a C corp isn't really the right thing to go to. I would not say to do a C corp. And then there's the LLC, and if you're a single owner LLC, that gets treated as being self-employed. You still have the protection of an LLC where you can't lose your personal assets in a lawsuit unless they deem you intentional fraud. Got to make that disclaimer. But the taxation of it is still the same. So your $30,000 net profit gets taxed as ordinary income and self-employment tax. So, good question, and hopefully we helped you, and that's what we love to do, is help people here at EG Tax. If you want to, reach us at our office on Airport Pulling Road, right across from Tamiami Ford, 239-262-2009. Our staff there would love to help you. We look forward for you to join our family.
Okay, I'm ready. Okay, so I've got Trish from Tonawanda who asks, Esther, my sister and her daughter moved in with me about a year and a half ago. Was only supposed to be 2 months. She has a small part-time job and makes about $3,000 for the year. She also receives child support in the amount of $100 a week. Is there any way my husband and I can claim either or both? We pay for everything in the house. My sister and her daughter moved in. She was part-time, makes about $3,000. And so you want to tell them the good news, Chris?
Well, there's good news and there's bad news. You gotta play the game. You gotta look at both aspects of the return. Yes, I mean she gets $5,200 and $3,000, so she has income of about $8,200. You gotta look to see if you spend more than $8,200. First of all, to see if you can claim
Support worksheet.
a support worksheet. So I would say probably yes, that you can. But you got to look to see what the impact is to have your sister and her daughter on your return, because that may save you $2,000 in taxes. Woo, yes. But you know what? With earned income credit and a child tax credit, an additional child tax credit, your sister may get a refund of $3,000.
So usually when I have a tax person in this situation, and I'll run the numbers, and I'll try doing her sister and her daughter by herself, and then I'll do it on the other tax return, and we'll, because it also depends how much Trish and her husband made too, and so you got to really run the numbers and see. It's a tricky situation, but it's a really good question, and a lot of parameters. Gosh, if this was at the end of the year, I would have told Trish's sister to go get a job, another job, so that her earned income credit would have been higher, and increase that in the additional child tax credit.
Right, because if she made another $7,000 in wages, which would have helped you guys out
in the household.
as a household, that then her earned income credit might jump from $1,500 up to $3,000 or $4,000. So you got to look and get the tax advice because
And then another twist on this is you want to make sure that the sister and her daughter have health insurance. Now, if you put them on your return and they qualified for Medicaid, that would throw them out of the mix for Medicaid, right?
Yep.
So now you also want to think about the health insurance
aspect of it now too. Yep. And also who knows? Maybe she had to deal with her ex-husband. That the ex-husband gets to claim her daughter. So be careful. You got to ask more questions before just putting them on your return.
Okay. Lily from West Seneca writes, Esther, I was told that when my child goes to college, my refund was going to be about $2,500. When I did my tax return last year, my refund stayed the same. When I asked the preparer, she said, I don't know why. Can you please help me understand? Well, you might have some other thoughts on this, but I was wondering maybe she had financial aid that paid for all of the tuition, or another thought is that the return wasn't done right. What do you think, Chris?
Right. There's many possibilities. You're right. Maybe it was financial aid or scholarships that paid for the tuition. So there was no educate. There might have been room and board, but that doesn't count for this.
But what makes bells go off in my head is that the preparer couldn't answer it. So if the preparer couldn't answer it, I'm hoping that they didn't miss the credit.
Right.
Because the preparer should be able to tell them, well, the reason you didn't qualify for the American Opportunity Tax Credit is because of the scholarship or
maybe your income was too high. So yeah,
I would bring it to our office and have us take another look. I'm just alarmed that they couldn't answer that question for you.
Right. And we're from EG Tax. We'd love to help you down in Florida. If you want your questions asked on the radio, give us a call at 1-800-616-9236. That's 1-800-616-9236 so we can get you on the air. But remember, we're on the air in Buffalo, New York from 3 p.m. to 4 p.m. on Saturdays. So if you call when you're listening to this, you can say hi to the producer, but you're going to get somebody else's show. So give us a call from 3 to 4 on Saturdays. You'll hear you the next week. Our office at 1450 Airport Pulling Road, which is right across from Tamiami Ford, is there 6 days a week to help you. Their phone number is 239-262-2009. So come join our family and let us help you.
Okay, I have Greg who writes, I am 50 years old and I started thinking about retirement planning. I will only have my 401k and Social Security. My income is still low enough that I could contribute to an IRA. Should I put money into a Roth or a traditional IRA? Well, that's a really, really good question and a common question. And a lot of times when you talk to a broker, instinctively, they'll tell you to put it in a Roth because the truth is with a Roth, it grows tax-free. And when you pull it out, it's not
tax-free.
It's not a taxable event. However, something that you want to think about is when you retire, are you even going to have to pay tax? And so right now, you're going to pay tax on that Roth at this higher tax bracket because you're still working and you're earning wages, and so maybe your tax bracket's in the 15 or 25%. So when you get the Roth, you're going to pay taxes on it where you're currently sitting. And so, but the truth is, when you take it out, maybe you wouldn't have to pay taxes. So you could be shooting yourself in the foot, right, Chris?
Right. It almost sounds like your income is going to be lower when you retire because your Social Security may not be taxable. So with looking at this, I would almost say doing traditional IRA, get that tax savings now, and run with the extra money.
And don't forget, when you put money into a traditional IRA, I think Chris was alluding to this, there's an adjustment on your tax return that you get to claim on the first page in the adjustment section, potentially. And so there's that. And then maybe on page 2, there's a retirement savers credit. And so you'll want to make sure that you look at those items too.
Yep. Let the government help fund your retirement plans. Great tool for investment there.
I'm ready. Yeah. Okay. I have Sally who writes in team. I'm selling my house and I'm calculating a gain of 100,000. How long do I have to invest in another house so I don't pay any taxes? Well, correct me if I'm wrong, Chris, but I think that goes back to an old law. The truth is, if this is your personal residence and you've lived in it for the last 2 out of 5 years, and if you're single, you don't have to worry about a gain unless it's more than 250,000. Married, unless it's greater than 500,000. Do you think she's thinking of an old?
Oh, she's thinking of the law going back before May of 1998.
Okay, I've been doing taxes for about 16 years, so
That's before your time.
Before my time.
Yep, but people still remember that old law. I remember the old law. You used to have to buy a new house within a year and a half.
Wow.
So, now you don't have to.
Right.
As long as you lived in that house 2 out of 5 years, you can take that $100,000 and have a great big party. Just remember to invite us.
And then, And then another thing is, say this was a rental, that would be a host of a different color. She'd have to worry about claiming the gain. But we work with an exchange person, and so something to think about if this was, just hypothetically, if this was a rental, you might want to do a like-kind exchange, and so you need an exchange agent to carry that out, right?
Right. And we can help you with that, but in the definition, you can take that 100,000, go buy another house, sell that house 3 years later, and if you made another 100,000, it's still tax free. As long as you lived in a house 2 out of the last 5 years, selling that house is tax free. That comes into play, like maybe mom passed away or dad passed away and you inherited mom and dad's house. Or maybe your name was put on mom and dad's house before they passed away. So it goes back to the original basis. So they may have bought the house for $50,000, and now the house is worth $300,000. So there's a gain of $250,000. Maybe you sell your house, move into you lived in your house for 2 out of 5 years. You got that gain tax free. Move into mom and dad's house for 2 years, sell that house, and now you just made that money tax free too.
Yep.
So, there's different games, hate to sound like that, but there's loopholes that you can use to your advantage. It's not just the rich who gets the loopholes. There's loopholes for everybody. And that's what we try to do at EG Tax, is to optimize your refund or reduce your balance due to the legally lowest balance due or legally highest refund. And if you want to join us, come join our family. We're located at 1450 Airport Pulling Road, right across from Tamiami Ford, in between Fabio Pizza and 7-Eleven. Our phone number there is 239-262-2009. We look forward to you joining our family.
Okay, I'm ready. Okay, Steve says, Esther, my company said they would like me to go work in their plant in Columbus, Ohio. They said it could be as little as 4 months and as long as 10 months. This could end up costing me about an extra $750 a month plus my gas for coming home once a week. Is there any is this deductible? Well, the good news is there's something called a temporary assignment. A temporary assignment is if it's anything less than 12 months. And so these parameters are met when he talks about 4 months and 10 months. So this is on your Schedule A. And a temporary assignment, you can take your mileage, you can take your living expenses, you can take your cost of using your utilities if you have to pay for your place of living, your food, right, Chris?
Yep.
And so he's in an okay situation.
Right. So the extra money that it's costing you you're going to be able to use to write off. Now, you're not going to get a dollar for dollar savings. It all depends on your tax bracket, but at least you're going to be saving some of the money. You're going to be recouping some of that money back on your tax return. You know, you may want to go to your employer too and say, look, I'm willing to take a $10,000 pay cut if you pay for my expenses down or up there or down there, wherever you live in Ohio, because then that money's not coming out of your pocket, so you're saving the money.
That's right.
So
Yeah. So that's an option. And then if that doesn't work out, because you're a temporary assignment, you can take off lots of expenses, things that aren't afforded to somebody who isn't in this temporary assignment situation.
Right. We're from EG Tax. We want to help you. Come join our family. Give us a call down in Naples, 239-262-2009.
Okay, I got it. Okay, I have, it says team. It doesn't have who wrote in. My father is 85 and he wants to close out an annuity. He said he would rather pay the tax than me after he passes. The taxable amount would be around $210,000. Is that a good idea? Also, can he write off the $4,000 penalty for closing it early? And so I'll have you maybe talk about the penalty for closing it early, but I think that's a good idea. If his dad is in a lower tax bracket than the son, although son would be in, that's a fine idea.
Right. Well, you first of all, let's go back to the penalty. The penalty is not deductible because that's going to come out off the top, and you haven't paid tax on the growth yet. So you can't do anything with the $4,000 penalty. The $210,000 gain, you got to look at what tax bracket you're in now, what tax bracket dad's in now. If dad wants to do this, he may want to take out $50,000 a year for the next 4 years.
Yeah, that's
So to defer that tax, because $210,000 adding to dad's income, he may pay 30% tax, 33% tax. But if he does it over 4 years, that tax may come down to 15%. So that's an extra 18% that you guys win.
Right. But again, he has to do his homework. What tax bracket are you in? What tax bracket is he in? And Chris raises a really good point. I like the $50,000 a year over.
Because also, when dad dies, if it's still in an annuity, you have options. You can annuitize it over all your life.
5 years.
So you're not going to pay tax on it all at once, over 5 years. So there's a lot of different planning to do. Don't just do it. I'm glad you called or wrote in and asked this question. So I'm hoping we answered. I know Esther answered this question by an email already, but hopefully you're hearing and it's reiterating what Esther told you to do. So thank you very much for that question.
All right. Okay, Erica from Cheektowaga writes in, EG Tax, I want to put on a fundraiser for a neighbor. Their son is sick and their medical bills are piling up. The money we raise, is that going to be taxable to them? Do I need to do a separate tax ID number for this? Please help. Just want to do the right thing. And so the money is not going to be taxable to the folks that you are trying to help. And what an honorable thing that you're doing. And then how about the tax ID number?
Right. Because if this was going to be an ongoing thing, you could start a not-for-profit, but odds are this is a one-time event you're doing. So no, you don't need a separate tax ID number. But what I would do, if this is cancer, I would contact the American Cancer Society and say, can I have a fundraiser being offered through you for this family? Because at least then the money that people are donating would be deductible. Mm-hmm. And so that would help them. It would, and help the people to want to give more money. Also, your supplies that you buy, the food, the prizes if you're doing raffles, that's all a deduction too. But it has to go through a non-for-profit in order for it to be deductible. But again, we commend you on doing this, Erica. It's a great thing. If you have questions and you want them answered on the radio, give us a call here, 1-800-616-9236. Remember, though, this radio show is in Buffalo from 2 to 3 o'clock, or from 3 to 4 o'clock on Saturdays. So give us a call during that time. You'll get us live, and then the following Saturday, you will hear that show, your question, live on the radio. We're from EG Tax, and we'd love to help you. Come join our family. We'll do
Okay.
one more.
Yep. Okay. George from Tonawanda says, EG Tax, my employer reported that they're going to drop my health insurance but give me a raise of $4,000 to help pay for my own insurance. Can they do that? My insurance is now going to cost me $1,000 a month for the cheapest family plan. Well, Chris.
Well, actually, no, they can't. Employers cannot do that. They cannot give you a raise to help you pay for health insurance out on your own. I mean, they can, but the penalty is it's $100 a day per employee. So you're looking $36,500 on a normal year. This year's a leap year, so you're looking $36,600. So if they have 5 employees that they're doing this for, so 5 times 36.6, you're looking a penalty of $183,000 they would be assessed because they didn't want to pay maybe $20,000 in health insurance. So they're going to lose $163,000 by doing this.
So run over to your HR, your benefit person, and tap them on the shoulder and say, this is not a good plan.
Right. So hopefully, and if you need help with health insurance, even if you're down in Florida, we have a healthcare specialist on staff that can help you, Tim Eliason. Just give us a call. We can get you right in touch with him. Up here, our 1-800 number for our EG Tax is 1-800-829-9998. That's 1-800-829-9998. You could go to egtax.com, ask the tax lady, and say, Esther, I need help with health insurance. Give me Tim's number, and she will give you Tim's number. But we look forward for you guys to join our family. Thank you for listening.
Okay. Now, how did you, do you want me to send these to you via the FTP?
If you can, and I think
They'll have to edit it.
that's what he does anyways. He edits these to fill in with the show.
I'll send it to you,
Okay,
and it should have it probably by the end of today.
perfect. And we'll get him down to Charlie.
Thanks, Kevin.
Thank you.
Glass of water after all that.
I know.